We choose the company name is Kuala Lumpur Gerbong Berhad, short form is KLK. It is a company incorporated in Malaysia and it is listed on the main market of Bursa Malaysia Security Berhad with a market capitalization of approximately 23.5 billion at the end of September 2012. Here is the company mission. About company values, which is KLK company's key indicators. There are 6 points, which is those are some important profile of director, which is after introduce the company, we turn to introduce to you what is their core business. There are some of KBK company's production. As you heard just now, they have a lot of production in their company. Let's come back to their business.
The current ratio for Kapong Company in 2011 is 1.49. 2012 will be 2.07, which means the company has 2.07 times of current asset to meet requirements of its current liability. We show that 2011 is lower than 2012. Next will be the quick ratio for the Kapong Company in 2011 is 1.47. In 2012 will be 1.98, which means that the company has 1.98 times of its more liquid asset to meet the requirements of its current liability. We show that 2011 is lower than 2012. Next will be the inventory turnover. In 2011 yet is 15.4. In 2012 yet is 10.9, which means the company are able to sell off its inventory for 10.9 times per year in 2012. So it shows that 2011 is higher than 2012. Next will be the average age of inventory, which means stock turnover. In 2011 is 23.7. 2012 will be 33.5. The company are able to sell off its inventory in an average of 33.5 days. We show that 2011 is lower than 2012. Next will be the average collection period for the Kapong company. In 2011 is 10.46. In 2012 will be 7.66, which means the ACP is 10.5 days, indicating that the company collect its payment every 10.5 days for its credit customer in 2011. And ACP in 7.7 days, indicating that the company collect its payment every 7.7 days from its credit customer in 2012. It shows that 2011 is higher than 2012. Average payment period in 2011 is 27.87, which means the company pays to his creditor in an average of every 27.87 days. In 2012 is 42.64, an average of every 42.64 days. It shows that 2011 is lower than 2012. Next will be the value of Kapong company's total asset turnover in 2011 is 0.27. For each 1 ringgit worth of asset utilized, the company can generate 0.27 times of sales. The value of the Kapong company's total asset turnover in 2012 is 0.28. For every 1 ringgit worth of asset utilized, the company can generate 0.28 times of sales. It shows that 2011 is lower than 2012. The debit ratio of the Kapong company in 2011 is 0.29. It means that 0.29 of the total asset of the company were being financed by debt. The debt ratio for Kapong company in 2012 is 0.37. It means that 0.37 of the total asset of the company were being financed by debt. It shows that 2011 is lower than 2012. Next will be time interest earning ratio. The following 2011 value is 22.1. The company has 22.1 times of ability to pay off its interest. Time interest earned ratio for following 2012 value is 26.8. The company has 26.8 times of ability to pay off its interest. It shows that 2011 is lower than 2002. Next will be the gross profit margin in 2011 is 0.69. For every $1 of sales, the company is able to generate 0.69 of gross profit. Gross profit margin in 2012 is 0.68. For every $1 of sales, the company is able to generate 0.68 of gross margin. It shows that 2011 is higher than 2012. Next will be the company's operating profit margin for 2011 is 0.56. For every $1 of sales, the company is able to generate 0.56 for OB. Company operating profit margin for 2012 is 0.60. For every $1 of sales, the company is able to generate 0.60 for OB, which means 2011 is lower than 2012. Next will be the net profit margin for 2011 is 0.47. For every $1 of sales, the company is able to generate 0.47 of net profit. Company net profit margin for the 2012 is 0.52. For every $1 of sales, the company is able to generate 0.52 of net profit. We show that 2011 is lower than 2012. Next will be the company earning per share, EPS. in 2011 is 0.68. For every $1 of common stock inquiry, the company is able to earn 0.68 for them. In 2012 is 0.857. For every $1 of common stock equity, the company is able to earn 0.857 for them. It shows them 2011 is lower than 2012. Next will be company return on total asset in 2011 is 13%. For every $1 of total asset invest, the company is able to earn 30% for the common stockholder. Company return on total asset in 2012 is 14.4%. For every $1 of total asset invested, the company is able to earn 14.4% for the common stockholder, which means 2011 is lower than 2012. Next will be the ratio for Keppel Company in 2011 is 18.2%, and the Keppel Company in 2012 is 22.8%. It shows that 2011 is lower than 2012. Last but not least, the price-earning ratio at year-end 2011 is 32.5. The investors are willing to pay 32.5 for each dollar of the firm earning. The price-earning ratio at year-end 2012 is 26.4. The investors are willing to pay 26.4 for each dollar of the firm earning. It shows that 2011 is higher than 2012. Next will be the activities in the company. First will be establishing a subsidiary, and the subsidiary took the opportunity to expand plantation land. It will increase the fixed asset. Besides that, expand the market also have the development of the future. It will increase revenues and enhance gross profit as well. Next will be the company receive many government grant. Government grant will affect total asset. Total asset will increase. After calculated all ratio analysis, our group conclusion is to invest $1 million in the company. We have few reasons for why we will invest $1 million in the company. First of all, because of the current ratios, for most industry company, 1.5 is an acceptable current ratio. A company that has ratio around or below 1, which means the company has a negative working capital. And the quick ratio for the Keppel Company, the higher the quick ratio, the better the company liquidity positions. Next will be the total asset turnover. The higher the numbers, the better. This also indicates pricing strategies. Companies with lower profit margin tends to have high asset turnover, while those with high profit margins have low asset turnover. Furthermore, the times interest earned ratio, a high ratio can indicate that a company has an undesirable lack of debt, or in paying down too much debt with earning that could be used for other projects. This means that it is getting better compared with 2011 to 2012. When looking at operating margin to determine the quality of a company, it is better to look at the change in operating margin over time and to compare the company yearly or quarterly figure to those of its competitor. If a company margin is interesting, is earning more per dollar of sales, the higher the margin, the better. Profit margin is very useful when comparing companies in similar industry. A higher profit margin indicates a more profitable company that has better control over its costs compared to its competitor. Increased earnings are good, but an increase does not mean that the profit margins of a company is improving. For instance, if a company has costs that have increased at a greater rate than sales, it leads to a lower profit margin. It is an indication that costs need to be under better control. And the return on total asset. The greater a company earning in proportions to its asset, and the greater the coefficients from this calculation, the most efficiently that company is said to be using in asset. And last but not least reason is the returns of equity. The ROE is useful for comparing the profitability of a company to that of other firms in the same industry. For higher growth company, you should expect a higher ROE. So this is some of the reasons that why our group conclusions is to invest the 1 million in the company.